Great morning, everybody. So I have the embarrassing job of showing you what the actual results are versus active versus passive. So I don't know who we're really embarrassing, but we have to show these numbers, and we show these numbers globally. We've done this for more than 10 years in the US. In the last 2 years, we've also started covering South Africa. But the results don't lie. Over the last 15 years, the US has really had some bad numbers coming through. And the importance of that is if you see how big the US is relative to anything that is listed in the world. So you can see sort of the big blue block is the S&P 500, you can call that, but it's really the US listed space, making up more than 51% of all listed companies. You can see the sort of red slice there, that is the South African exposure. So we're less than 1%, 0.74 if you want to really look at that. What you'll also see is Europe sitting around 15%, and then also you have the UK around 6%. So you can see almost pre-Brexit, the Europe area was really about 20%. So between the US and Europe, about 70% make up all listed equities. China, again, the yellow bar, but that is really what everybody is trying to outperform. That is the opportunity set available to all active managers or all investment professionals that they can either track or try and beat. And that is really the game of what we're looking at. Now, within S&P, we actually cover this through various indices. We cover more than 1 million indices that we calculate per day. So even in the index space, it can become very complex as everybody's got a different view of how they actually want to access this pie. You either want to just access a country or a region or a style of investing, but everybody has a different view of that, and that is why we can now sort of slice and dice this pie to exactly the needs of a pension fund or a particular investor. Now, to clarify, I didn't call them active versus passive because they're not. That doesn't really mean anything to anybody. You have to say it what it is. It's stock pickers. It's people that are picking stocks out of that pie and trying to be better than that. So what is stock pickers? Stock pickers are people that are trying to give or promise you that they can give you excess return above that market. They also charge higher fees. And when they deliver on their promise, they charge you even more. Okay? But do you actually know who's picking those stocks for you year after year, year after year? So is the management changing? Is the staff changing that's doing that picking? Or is it the same people for the next 50 years? And then do you know why they are picking those stocks? Do you understand the strategy behind them picking what they are picking? And I think most people can actually say no. It's sort of a blind trust. We just believe the story when they come and tell us about one or two stocks to report back each quarter. They come and say, oh, well, this company's now done well and this company's done well. But they never give you the big story of how they actually do that. Because if they did, they will give away their secrets. They will give away their power of how they actually pick the stock. So it's a bit of a black box that they come and tell you every time. The results actually of how they then perform is what you can see is that 70 to 80% of all active managers can't deliver on that promise. They underperform the market. And this is not just the Alan Greys, the Coronations, the South African managers. This is globally. All active managers globally struggle to beat the market. But yes, there's 20 to 30% of active managers that do outperform. So we all live in hope. We all hope we select those year after year after year. And that's really what has been sort of keeping the active managers alive in this space. But again, they don't do that. They don't deliver year after year after year. And we'll only show you those results. So there's something called Optimism Bias. And that is really if you believe that you can do something better than someone else, or that you're better than someone else, or better than the average, but you don't really come back to reality. So in a way, the surveys or scorecards that we show is really showing what the reality is. Now, if I tell you that in the average room here, Do you think that you are a better driver than the average? Do you think that you're in the top quartile from the smartest people here? Do you think that of everybody here, people might get cancer or not, but you will be the lucky one that doesn't get that? We all believe that we are in the safe space. We're better, more beautiful, we can drive better, we're smarter, we're healthier. You're never going to say that you're in the bottom quartile. You always believe that you're better, and that's optimism bias. And that's exactly what active managers suffer through, as well as contestants on Idols. They believe that they can do this, but in reality, Randall will tell them, get back to reality, and they'll get some negative comments, and some active manager will actually get negative alpha, and that's really the reality. So what is then the other option to follow is index tracking. So these guys promise you that they'll deliver the market, they'll charge you lower fees, and when they do deliver the markets, they actually won't charge you any additional cost. They are very transparent, rules-based. They tell you exactly what they do, how they do that, and manage your money. So you know exactly what you're getting. The flip side then is obviously that they beat 70 to 80% of all stock pickers. Okay? And again, they do this year after year after year. It's not that they're not going to give you the market. So they deliver on their promise year after year. So very consistent performance coming through. Now at S&P, we run what we call SPIVA reports. Now it's S&P indices versus active managers. So what we do is across various regions around the world, we run 8 SPIVA reports, but we manage to calculate after-fee returns of funds relative to that region's main benchmarks. In the US, the S&P 500, for instance. In South Africa, we have our own S&P SWIX index, which we will then measure the managers against. We do this twice a year, so the next report will probably come out around about October to show you the mid-year results. But the results I'm showing you today is really the end of 2015 numbers. Now, when looking at these, we also have to exclude any survivorship bias. So any funds that have shut down, we do not want to include in these results because that will skew some of the results. We only compare apples with apples, so large cap funds with large cap benchmarks, mid-cap funds with mid-cap benchmarks, certain styles with certain style benchmarks. So you measure them according to the exact category that they fall in. We also show the results as equally weighted as well as asset weighted. So the equally weighted results always look a little bit worse. So that's why I'm going to talk about the asset weighted results. So the bigger the fund or the bigger the manager, the more weight it will carry in the survey's performance numbers. This is really the results that you would see around the world. And you can see that in the US, starting with the US, over a 5-year period, you can see that number 84. Now, 84% is not who's outperformed. That is the managers that have underperformed the S&P 500. These are the guys that you are paying a lot of money, living in hope. But in reality, they can't do this over a 5-year period. Now, in Europe, you can see exactly the same. 81% of all active managers underperform. And in South Africa, the previous year's results were also in the 80s. They've slightly improved. They're now around 75%. But again, 3 out of 4 active managers underperform the SWIX benchmark. And there's a lot of talk about SWIX is not an appropriate benchmark because Naspers is going up to 16% and they can't get their hands on Naspers and it's all Naspers' fault. Well, S&P has got another index called the SWIX capped. We've capped Naspers at 10%, and I can tell you now the results don't look any different. So again, Naspers is not an excuse for an active manager not to outperform those markets. You can see in Japan, it still makes up around 89%, but again, the active managers there over 5 years have about a 50-50 split, and that's understandable because somebody needs to buy stocks, somebody needs to sell stocks. So in general, you would expect that that's a zero-sum game. So in average, you should expect a 50% result. Year after year, these results change. And again, sometimes active managers do better than and sometimes they do worse. Now, in the last 15 years in the US, I can tell you only 3 years more active managers had outperformed the S&P 500. So looking at results around 40 to 45% has underperformed. But in general, year after year after year, around 60, 65%. And if you take that over a 5-year number, we jump back to the 70, 80% of underperformers. Now, in the South African survey, what we're going to show is the average equity fund and really how they've performed. And you can see that around the underperformance over a 5-year period for the average equity fund in South Africa was about 1.8%. So the magnitude of underperformance as well is also contributing to pension funds not really meeting the objectives. If you look at the top quartile, the best performing managers over 5 years, what you'll see is the alpha that they're generating is around about 0.4% and more. On average, on year, you'll see that the underperform the average by about 4%, and the top performers outperform by about 4%. So that's really the space that they're playing at. And this is almost a 1-year, 3-year, 5-year number that you can look at. Now, if you think it's difficult to outperform the SWIX or the South African market, it's really difficult to then start playing the global space, because now you don't need to just manage stock picking. You now also need to manage currencies, regional exposures, countries exposures, and so on. And what you will find is that the funds available to South African investors that is managed on a global equity basis, about 97% of those active managers have underperformed. In reality, one manager has outperformed over a 5-year period. That is the results. So it's very difficult to start playing in the global space as well. And you can see the underperformance also around 2% in this space. Now, it's great that we say that, yes, there's 30% or 20% of fund managers that outperform. But the real question is, can they do this year after year? And the answer is no. If we start just looking at US results here again, starting off with about 2,500 funds, and after the first year, we select the top quartile, the top 25% of funds. That's around 703 funds that make it through. Now, if we then take the next year to see how many of those funds are actually now for the second year into the top quartile, the number drops to 146. Okay. After 2 years, that number drops to 49. After 3 years, the number drops to 9 or 13. And after 4 years, 2 funds could for 5 years in a row be top quartile. Percentage-wise, that's less than 0.5%. So you're better off with a cat as well, trying to pick the correct fund manager when picking stocks as well. So it's really, really difficult for active managers to consistently outperform as well. The other thing that active managers are really facing is this theme of smart beta indices coming through. So they no longer just have to compete with vanilla benchmarks or market cap benchmarks and outperform those. There's now these new technologies and new indices that says, well, if you're a value manager, you should actually be beating a value index. Or if you're a momentum manager, you should try and beat a momentum index. Because the quants have done all the work up front to construct this portfolio, this index, which is now momentum. So if you're a momentum manager, you should try and beat that. Because the robot, for low fees, have already done most of the work. So they find it very difficult to now sort of still prove that they have skill above sort of the index space. And when they need to start proving that, a lot of people have said, but active managers should be more active. They should take more concentrated bets, because then they'll show more alpha. Now, we've just released the report as well, or a publication called Fooled by Conviction, because what happens when active managers start doing this? So conviction means that instead of playing with 100 stocks in South Africa from the 150, we now drill down to 20. A very concentrated portfolio. These are my best bets. I've done all the homework on these companies and I believe in them. Now, when you do that, you obviously increase your risk, because if you have 100 stocks and 50 are wrong and 50 are right, you're still neutral. But if you select 20 and none of those 20 were correct, you can have massive underperformance. So you're increasing your risk of not getting the ones that have outperformed the market, which means that pension funds now need to select more managers to diversify more as well in this space. And when doing that, we actually have no idea if the managers that we're selecting have actually got skill, or is it just pure luck? Are we just taking the cat that has now selected these stocks for us and might get it right? Or is it somebody that's really put in the hard work, selected these companies, but got it wrong? So we're almost losing the idea of what is skill and what is luck. And that is really something that is difficult for pension funds to start justifying, selecting these managers as well. Now, again, that concept of 100 stocks to select from, but you're only playing with 20, when you're only playing with 20 and you have to implement that or rotate that portfolio, your cost would also increase by changing that basket maybe more frequently, or bigger trades to change that amount of money. So the cost of implementing these strategies will increase, but again, cost reduces performance as well. So again, reduced returns coming through as well. So it's a very difficult space for active managers. And again, I think they would need all the help from the index providers that have almost already screened for some of these strategies that they're using, and then selecting from those, or becoming more passive in their thinking about, then again, they can't charge the higher fees. But in reality, what we are seeing is that it's very difficult for active managers to justify their performance relative to an index. Okay. So this is my final slide. So I think from Stephen's presentation and these results, you can go onto our website and also pull any of these surveys. But now that you know the facts, are you actually going to do anything about that? That is the big question. Okay. Thank you very much.